Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. My guest today is Lorenzo Esparza. He's CEO and founding principal at Manhattan West. And we'll be talking about alternative investments and his approach to building his wealth management practice. Lorenzo, thank you for joining me this morning.
It's great to see you, and it's wonderful to be here. Thanks for having me.
Yeah, absolutely. So where are you based? You're in LA, right?
We are in Century City, right at 1999 Avenue of the Stars in Los Angeles.
Were you one of those ones that got the text message from the grid operators that says to, lower your consumption?
I think we all got that text message. Yeah, I think if you're in LA County, everybody got that text message. First time I've seen that, but yeah, I was a recipient.
Yeah, that was fascinating when I read about that, and then how they were able to really say that after they sent that text message, people really lowered their consumption. I got to imagine that's a big topic or a big concern for people out west, and just the potential for whatever it is, the grid stability and rolling blackouts when it comes to it.
Yeah, look, I think it hits you kind of on both ends, right? When it's really cold, and you put stress on the system, and then when it's really hot, you put a lot of stress on the system as well. And I think we're really pushing the envelope this year, given the heat wave that we've had.
Let's talk a little bit about your firm, Manhattan West, and maybe you can tell me a little bit about the services you offer and the types of clients you work with.
Sure. Well, I always talk about the two aspects of our business. One is a wealth management ecosystem that we've built. We do traditional investment management. We do business management, which is personal CFO services. We offer tax and accounting. We do insurance planning, and we really try to create this ecosystem that allows clients to participate in all of those services. They're certainly not required to do so, but we have them available if they would like to have, kind of a one-stop solution for their financial service needs. And so that's one part of our business. The other part is that we've really tried to stand up our own alternative investment options, and to do so in a way that, is meaningful, that allows our clients to participate, again, only if they choose to. So we have a private equity fund and a team. We've got a real estate team and offerings in real estate, venture capital, and private debt. And so there's groups within our firm that handle each of those asset classes. And we're really trying to be an asset manager in addition to a wealth manager. So we think it's important to really take responsibility for the outcome of portfolios. And we like our chances when we're in charge of building these portfolios out and really executing on our strategies.
And you spent your prior career also in wealth management and planning with clients?
Yeah, I tell the story that, my parents were immigrants from Mexico, and they told my brother and I, be a lawyer or a doctor. And so I actually ended up going to law school and graduated, but really focused my career in financial services. I started at Bernstein, a firm I have tremendous respect for, went through their whole vetting process, which is, I think, unlike most firms on Wall Street, and had a good run and enjoyed the folks that were there, and eventually went to JP Morgan, another great organization, great reputation. I have tremendous respect for Jamie Dimon and the culture that he's built, first-class business in a first-class way. That was really, the culture that attracted me to that firm. And then, after doing some soul searching, the idea of building out something different and challenging myself to really create something led us to build out Manhattan West. And so here we are 6.5 years later, and excited about what the future holds.
How did you approach building your new business, building the client base in your new business, whether it's how you marketed yourself or distinguishing services that you decided to offer?
Yeah. I wish we really have not done a ton of marketing. I think it's only in the last year that we've begun to even think about it. Everything's been really word of mouth, and, just focusing on doing great work. And I always say to folks, whether it's $1 million portfolio or 10 million, as long as you do great work, you'll get opportunities that come from that. And so we really just leaned into performance and customer service and trying to be, great advisors to our clients. And that's what's led to our growth. And now we're, at a different stage in our evolution. And so we're looking at more of the mainstream opportunities for how we, how we market ourselves and how we, reimagine our website and marketing efforts and what have you. So we're taking all that into consideration as we build our 5-year plan.
The pandemic changed a lot for a lot of people in different ways. We all started using Zooms and what have you. But I don't know, was there anything for you that really changed in the way that you approach business? I mean, other than just doing Zooms, but is there anything long lasting that you're taking away from the pandemic and the way you work with clients?
I would say a couple things. I mean, look, I'll be the first to admit when the pandemic hit, I was concerned. As a business owner, you're staring into this abyss and you're worried about what's going to happen. But I felt that we had a good business. I felt that we had a good understanding of where the markets were going. We ended up growing through the pandemic and through 2020, and launching into 21, having our best year in 21 that followed. But I think the lessons were just to really focus on what your core understandings are and what your beliefs are. When oil was at zero, we knew it was going to come, it would come back, right? We didn't think we'd stay in this perpetual $0 oil, structure. When the 10-year was at, near zero, and, could we go into negative rates? It may be, but we thought the probability was that we would go higher from there. So we made investments around that thesis. So I think it was just you got to stick to your belief system and what made sense. It's not unlike what Buffett has said, and people have quoted a million times, right? Be greedy when people are fearful, and fearful when people are greedy. And that was a moment when we were fearful, right? I mean, I don't know how you can look at that environment and feel good about it, but we leaned into some beliefs that we had that were longer term, and it turned out to be a good outcome.
Yeah. I mean, the sell off in 2020 was so dramatic and so deep, so fast. I guess if you're a student of market history, you got to think that there had to been some opportunities there. But did you have any tough conversations with clients? Did they push back on anything?
I will say that when you manage money for private clients, they tend to be a barometer of at least a handful or a sample set of kind of what the public is thinking. And so, markets are cratering, and the tough conversations are, yeah, let's just sell everything. Just sell equity. Just go to zero. Who knows where this is going? And that's a tough emotion. Just the behavioral economics around how people feel and how much they don't like to lose. People hate to lose more than they like to win. And so having the conversation of saying, hey, look, we're not selling, hang in there. In fact, when it gets really bad, that's when we, shift and we buy more. And so those were the conversations I think that were probably most challenging. But, thankfully, we have a pretty intellectually advanced client base that understands, markets, right? It's a sophisticated client base. So it's only a handful of folks that I think can panic in times like that.
Yeah. Over the last 6 years, as you've built your business, what lessons have you learned that maybe you wish you had known before going into business?
Wow, that's a great question. I would say that, we really focused on just hiring the right people, and we kept our bar high. So I talk about these pillars or these prongs, right? You have to have a great educational background, great work experience, but most importantly, great people. And those three litmus tests allow us to find the right people. But I'd say that lesson is just never to veer from it. And I think you can't get human capital right every time, but I think when we've been focused on those things, I guess the mistakes I've made have just been in missing some of the red flags that were there, or seeing them and not acting on them. So
from a human resources standpoint,
human resources standpoint, absolutely, yeah. There's some challenges we've had that you kind of look back in retrospect and say, yeah, I should have saw that.
Do you find challenges in finding people today? Kind of with the whole shortage of workers and what have you?
Yes and no. I am so thankful and appreciative of the people that we have here. I mean, it's a lot of really exceptional people. And I'm, again, thankful when the folks that we meet that want to be here are interested. I mean, we probably have 5 or 6, larger roles that we're trying to fill. And the caliber of people we've been meeting, including, a young lady I met yesterday, a gentleman that's coming in today, a person that was here on Monday. These are really exceptional folks, and I think they appreciate the culture, the excitement, kind of the differentiated, offering that we have here, and they want to be part of it.
One of the differentiating features, and you mentioned it earlier on, was building some proprietary strategies. Was that a key desire when you were starting the business to be able to do that, and a key feature from the start?
Yeah, look, it absolutely was. I think it's two things. One, if you looked at how Bernstein managed their business, they're a proprietary firm, and they, lean into this is our, strategy, and I liked that as a construct. I think that's, a good way to manage money. And so that was important to me that we would build out these strategies on our own. And it's not easy, right? But it was something that I thought was important. And number two, when you're at a JP Morgan and you can allocate to the quote unquote best managers, the lesson there is that they don't always outperform. In fact, sometimes the larger the firm, the lower the alpha. And so, we believe that if we right size the opportunities, that we could build strategies that worked. And so, that was important for us as we envisioned the platform.
And in particular, the types of strategies would fall into the alternatives bucket. Or are you doing things in more core asset classes too?
Combination, right? I mean, look, the core asset classes of equities and fixed income, it's become highly commoditized. It's offered by a lot of different, places. We think we do a good job at it. We have, an in-house team that manages equity and fixed income portfolios, but it's really the proprietary strategies, like what we think we can do in private equity, what we're doing in venture, what we're doing in, real estate. Those are, tangible, opportunities that we stand behind and we like, and we think that are suitable for clients that are qualified. So yeah, those are the things that really, differentiate our offering.
In terms of investments that provide differentiated exposure to client portfolios, alternatives being obviously that, there are different ways of accessing alternatives, whether accessing funds of other managers or other private offerings, or I guess I know there are various tech platforms that provide people access to different opportunities. Can you speak a little to that, and and why you didn't go down that route?
Well, we do a combo of that. It's primarily, our own proprietary strategies. But for example, in one of our, venture funds, we think that the competency of our particular portfolio manager, in this case, Reggie Tucker, it would be foolish of us to not, lean into those relationships that he has and use other managers. So we have a strategy that does work with other managers where you allocate into those funds, and have had success doing that. But other strategies, so real estate, for example, we're actually acquiring real assets, repositioning those assets, and then putting clients in there where they're receiving a dividend distribution based on rents. So those are kind of just two different ways that we're doing it.
Does the desire to build out a particular strategy, in this case real estate, like you mentioned, does that come out of a specific client need, or you guys decide to say, well, we think there's an opportunity in real estate, let's put together a fund and market it to our clients?
I think it's both, right? It's both because, one, we do think there's an opportunity to acquire multifamily units and to hold those indefinitely. And so when you talk to traditional clients where all they've been exposed to is equities and fixed income, and when you have the Barclays Ag down more than 10%, those are clients that rely on fixed income for their dividend distribution. Well, those same clients are happy to hold a hard asset or real asset and receive income from that and not see that mark to market value decrease. So I think it's really just responding to clients saying, what else are we going to do? As we sit here again, the Barclays Ag is negative year to date. The equity markets are down significantly, and so if all you have is equities and fixed income as a solution for clients, I just think you're under prepared, right? You're taking a knife to a gunfight, and we firmly believe that for qualified clients, having an allocation to alternatives and to think about things like private debt and real estate as a complement to your fixed income, and to think about venture and private equity as a complement to your equity growth strategies. That's, just gives you a little bit more flexibility.
Yeah. You mentioned multifamily real estate. That's obvious of interest to me also, just from as an investor standpoint, investing in some single family homes and looking at different segments of the real estate market. I don't know. Can you talk a little bit about some of the metrics that you look for multifamily? Are you looking mainly in the California area, or are you opportunistic kind of nationwide?
So when we first started, we were primarily focused in Southern California. We want to be able to drive to these properties. We're now starting to think about expanding to other secondary markets like a Phoenix or Las Vegas or Portland. So other markets outside of Los Angeles. But we have a specific approach where we use low leverage. We have banks that give us great lending rates, and that's been one of the helpful things that's happened for us. And unfortunately, if you look at this, CPI read yesterday, rents keep going up, and frankly, that's what we've experienced with our properties. Rents, every time we replace a tenant, it's with a new rent, a higher rent, and so housing costs continue to go up. If you look in Los Angeles specifically, we're dramatically underhoused. And when you look at Los Angeles and you have education centers because of USC and UCLA, and you have the film industry, you have Silicon Beach and all this tech that's happening. There, all the financial services firms and professional service firms, law firms, accounting firms. There's just a lot going on in Los Angeles, and so we think it's a vibrant market. We think it's one that probably overtakes New York as the largest, DMA over time. That is one of our beliefs, just because of this urban sprawl. You're doing, urban infill replacement. So you go from, having a property with, a couple of units, and now all of a sudden it's replaced with, a larger subset of apartments. So, we like that sector for long-term investing and for collecting quarterly dividend payments from rents. And as long as you're using low leverage, and as long as you're managing, the rents, and you're in markets where there's a proof of tenant demand, those are really good ingredients for success.
Do you look for a specific cap rate?
Cap rates have shrunk given the demand for that asset class, but 3 and 4 cap is kind of where you're at with with kind of better the new builds, and even the value add stuff that's like nearly new properties or reimagined properties. So that's kind of an area that we think is generating a 4 cap.
And since we're on the real estate topic, for investors, what's the benefit of going through an approach like you're offering? I'm assuming it's a private offering, as opposed to, say, a REIT or something that focuses on multifamily.
Yeah, look, we depreciate the assets, so we think that we can generate, income for investors and then do so on a tax efficient, basis. So that's another attribute to it, and you just have more control. I mean, it's go read the prospectus on a REIT, right? That'll take you a while. I mean, it's quite complex, and so we like just a more meaningful allocation and direct ownership. I think our clients appreciate that. And so we're delivering that exposure. And
in terms of alternatives in general, how many different strategies do you run, or how do you decide to launch a new strategy?
I always say, look, we're not looking for a strategy trading pork bellies, right? We're nothing esoteric, but we want to go into strategies that we think there is demand, where there's definitely, a thesis around growth. I would just, for example, say private equity. My money is that it would outperform public equities over the next 10 years. In venture, for those that have the time horizon, there's been some great success in the venture space. And I would say, 20 years ago, you just didn't see that many people investing in venture. Now it's come, more mainstream. Those are two areas that, give you opportunities that, don't have you so focused on, what is the S&P doing this year, right? I think the way we've selected those asset classes, that we think there's assurances of reliability around how they'll perform over time, especially with, the right manager.
What would you advise other advisors, would you tell other advisors looking to either develop their own alternative strategy or looking at other alternative strategies? What's something to think about that they should keep in mind?
Well, I would say, look, it's capital intense and it's time intense, and it's not a short term, flip the switch, right? Institutional managers can go out and replace a sleeve and buy up a small cap manager or a large cap manager. But if you're going to go out and develop your own strategies, it takes time and it takes capital. You have to have a portfolio manager that really has an experience level that can bring something to the table. You're going to need a team to be able to push through the challenges of launching a fund one. I think, I know I have a lot of friends in the alternative space, and, folks that have come from very credible, big alternative firms, and, they go to raise a fund, and I say, well, how much did you raise? Oh, 2.5 million. I'm like, okay, that's not that much, right? If you just do the math on what the fees are on $2.5 million, it's not enough to, build a practice. So we've been fortunate that the overall business itself gives us the opportunity to kind of build out these strategies. So we can kind of start something. There's a J curve and how you start it, and then you build it out, and you're accelerating through that. But that's probably the biggest challenge is how do you how do you put these teams together in an efficient way and raise capital quickly?
I can imagine the organizational effort around it initially it can be tough.
Yeah, no, of course. I mean, look, everything when we launch a new fund, there's a real process for what we're doing, whether it's the name, the tax ID, the entity formation, the operating agreement. There's just so much that goes into really birthing that entity, building it out, having a business plan and a business case for why you're creating that strategy, and then raising the capital, and then implementing the capital and executing on those investments. So again, not for the faint of heart, I'll say that.
Yeah. How do you allocate to alternatives in a portfolio for your clients? Rule of thumb, kind of allocation percentage, and do they have multiple strategies in the alts bucket?
Sure. Listen, I'll say that our general thinking is that we like to start with a base case of a third in alts, a third in equities, and a third in fixed income. And that's not a new idea. That I think the private bank at J.P. Morgan has ideas that are similar to that for large clients. And so we kind of start with that as the baseline, and then we shape the allocation with that framework. So, for example, maybe there's a client that fits that allocation, but in their alts, they don't want the time horizon that comes with private equity and venture, and they want income. So you're using that third in real estate and private debt. Right. So you have shorter time horizon, income oriented, and then maybe equities are creating too much risk. So you bring that down from 30 to 20, and maybe your fixed income goes from 30 to 40. So that's kind of our baseline approach. And then we shape it around that, around the fact set of the client, and then build a custom portfolio.
Are there exposures or strategies you wish were available in the marketplace that are either hard to access right now for you, or you think the market needs?
I think we're getting access to the ones that we think are meaningful, right? I mean, do I need exposure to emerging market debt? Those opportunities are out there, but I think there's enough allocations that we could live without that. I'm using that as an example, of course, but no, look, I think we're trying to focus is on just absolute returns, right? And so how are we getting absolute returns in any market environment, right? So I think we're doing the portfolio that I describe in general, I think is doing very well relative to what a traditional 60-40 portfolio is doing year to date. We're not trying to find the next new asset class. We're really looking for, again, assurances of reliability that makes it feel predictable. Now, having said that, do we like digital assets? Of course. I think you're seeing a market that has sold off tremendously. That's getting us interested. That Bitcoin at 20,000 seems like it's well off the highs, and we believe that whether you think Dogecoin or any other esoteric coins are great, you can't ignore blockchain technology. It's being used in a lot of mainstream technology companies. You can't ignore Web3. You can't ignore what's happening in digital currencies, the bigger digital currencies and their acceptance on a global scale. So we think it's our responsibility to really have a point of view, and so we do have some ability to access that for clients that it's suitable for, and are doing kind of an advisory platform around digital assets, and then we have a digital asset fund that is part of our venture offering that gives us a little bit of exposure to that as well.
And that digital asset fund is investing in cryptocurrencies or ecosystem players?
Yeah, I made a point to remind folks in the face of all these coins falling out of bed that we are not investing in coins. In fact, we're focusing on, as we talk about the miners, the pickaxes, and what have you, like the companies that are in that ecosystem. And what are the companies that are benefiting from Web 3.0 and the metaverse and blockchain technology? Those are the companies that we want to be looking at, and so they're technically classified as digital asset investments.
So what's your case for that space? That happens to be a big area that Van Eck is very focused in on as well. What's your case for getting exposure to it?
Well, I'll say, not just our own belief, but look at what Sequoia Capital has done. Look at what Andreessen Horowitz has done. They're making multi-billion-dollar, bets in the sector, right? And those folks know what they're doing. So in conjunction with, that, I'll say validation, we just think that most S&P 500 companies in the future will be tech companies. Not that they're selling technology and they're not selling SaaS, but they're converting a lot of their infrastructure to technology, and it's happening in a whole host of different facets. And so as a result of that, the way that blockchain technology, provides opportunities for a Starbucks, and I just saw Howard Schultz yesterday talking about this new movement and new kind of launch for Starbucks, and both in stores domestically and what they're doing in China. Companies are going to lean into additional technologies to survive. Look at what's happening in the auto industry. I mean, Gavin Newsom is saying every car in California has to be an electric vehicle. So I think you think about what Tesla is doing and how their cars are changing the way that we consume vehicles, the way that transportation is happening. So I just think that if you're a believer in the innovation of technology impacting the larger economy and most S&P 500 companies, then you have to be a believer in digital assets and that whole ecosystem.
Yeah, I assume you saw the news about the KKR's fund and tokenizing their private equity funds. Yeah,
of course. Yeah. I mean, look, and by the way, we have always taken the position that anything in the digital asset space those were going to be securities. And you read, I think recently, Gary Gensler came out at the SEC and said, well, this is what our thinking is. Well, we knew that was going to happen. And that's why we've always kind of taken the posture that those are securities. And then you just build your infrastructure around that. So I think that's also a good thing, right? Adding regulation and giving, consumers the confidence that there is a regulatory body behind it is important.
Yeah, indeed. I think that'll help. It'll help give everybody some guidelines, at least, and some surety of what the rules really are, right?
Yeah, definitely.
Are you finding that you're having to bring these ideas or like digital currency ideas to clients, or are you getting pushed by clients as well?
I'd say it's probably 20% of the clients are asking for it, and the other 80 is us saying, "Hey, what do you think about the following? This is our point of view and why." And so it's a combination.
Since this is a podcast about trends, what's one long-term trend you see playing out over the next year or several years?
Well, I mean, from a market standpoint, I think there's three things that I would be concerned about from a trend standpoint, right? The first would be, the Ukraine situation, right? Is that going to continue to rattle markets? Are they going to resolve the situation out there? Might Russia drop a low-grade nuclear bomb? Are we going to continue to support them? So from the standpoint that we've witnessed through the Afghan and Iraq war, that these things don't resolve themselves overnight. we see that trend of just instability continuing. The other aspect is the global concern around China and Taiwan. Is that instability in Southeast Asia? Could that, create additional fractures the way that Ukraine and Russia has? And then finally, I would just say this disconnect between media messages and the way that, folks have differing viewpoints, not getting political, but the election was stolen, the election wasn't stolen. This happened, that's happened. And so all of the information, I'll say disorder, right? Folks are living in different realities. And I worry that creates longer term trends that are getting more and more volatile over time. So those are the kind of the main things that I would say I'm worried about, but are based on these trends that I see happening.
So are you ready to play Trend or Fad? This is our speed round.
Let's do it.
All right.
Let's do it.
Alternative protein, trend or fad?
I think that's a trend. I think we're moving more toward alternative proteins.
Battery storage systems, trend or fad?
Again, I'd say that's probably a trend. I think as there's a movement toward, electric vehicles and electric functions and away from, gas turbine propulsion, I think you're going to see more batteries. So yeah. That's a trend.
And I don't know if you do this in your business, but direct indexing, trend or fad?
I'd say that's probably a trend as well. I think a lot of folks are doing that. There's a lot of closet indexing too.
And then finally, this was a new one for me that I just came across: bucket list living. Are you familiar with that term?
That sounds like a fad. I don't know. I mean, I'm just hearing that. So, but I mean, look, I think everyone says, I got this on my bucket list. I'd like to do that. So I don't know. That's probably a fad. I think with COVID and folks working from home, it gave folks a lot of time to, really think about life and contemplate what's going on when you're not in your house. And so things like, hitting your bucket list is definitely a fad.
And I probably should have said, and it's probably the same answer, but I probably should have said bucket list planning, because I actually came across this on some financial planner site talking about trends in planning. So it's like changing the planning mindset from save until retirement and then live to live now. And I don't know, somehow managing that.
Yeah. Immediate gratification. Look, that sounds very fad-ish to me.
Lorenzo, thank you very much for your time today. This is great.
Appreciate you having me. It's been enjoyable, and thank you for the time.
What's the best way for people to learn more about you or follow you if you're on social media?
We are reachable at www.manhattanwest.com is our website, and there's certainly inquiry there, but lots of different ways to find us.
Fantastic. Thank you very much. And thank you for tuning in to another episode of Trends with Benefits.